In this video, you're going to learn the key questions that you need to ask yourself to help you build a more personalized investment strategy. Stay tuned. Hey, what's up? It's Magda from Crypto Masters. Hope you're having a fabulous day. So the main question everyone's asking is, when do I buy? And it doesn't matter if it's a crypto market that you're talking about, or stocks or any other options we've been taught to focus on when buying assets to hold in the hope of seeing them hit the price moonwise and finally get you that retirement to the Caribbean at age 30. Say you've already decided what you want to buy. Now you need to figure out when to do it. And the answer to this question might be unsurprisingly more difficult than it sounds. So in order to help you figure this out, in this video, I'm going to ask you a series of questions that I'd like you to answer that will make you think a bit deeper about why you're doing what you're doing. So the first question is, are you an investor or are you a trader? An investor is someone that is in the game for the long run. This is a long distance approach. And a true hodler, you probably know the story of when a drunk long-term investor, also known as a holder, misspelled holder, and from then on, holding began to be known as hodling. So anyway, coming back to the topic, a hodler doesn't react to short-term price fluctuations and focuses on securing the best long-term cost basis for the asset that they have purchased. This takes a lot of patience, dedication, and faith, because most long-term investors see their first profits after a longer period of time where there is plenty of time to doubt your investment decisions and pull out. That's why the second group is called the traders. The traders are looking for short-term edges to be able to take advantage of, like take advantage of price fluctuations to buy low and sell high and repeat, sometimes even within the space of a day. So a trader has the opposite goals of an investor, since a trader wants to be out of the market and in fiat or in any other stable coin for the majority of the time. They are the ninjas of the trading world, looking to hop a ride on a price swing and jump off before it reverses once again. Now, this requires that you are a very effective trader. This takes experience and courage to find these opportunities. You're basically going against the crowd for maximum profits, and it normally takes quite a lot of technical skill. You need to be able to read charts with many factors that you need to take into consideration simultaneously. So most people like to sit on the fence and say they are a bit of both. You're kind of an investor because you like to hodl for the long term, but you like to sell before the price turns down again. And sure, you can be both to different degrees, but you need to remember that successful trading is all about thinking about what you are doing, committing to a path beforehand, and not changing your strategy in the middle of a trade when you lose your nerve. And sure, no one wants to look like the lost cause fanatic, but then no one wants to be that guy that is going on about how dedicated a hodler he is, when in reality he sold all his holdings the very moment things got rough, when they got scared of making a loss. And I ain't preaching to you. I know it's a difficult game and most people make the best decisions that they can at that time. But in the end, this kind of lack of commitment to the strategy that you decided upon at the beginning usually costs people a lot of money, if not everything. So let's get back to the question you need to be asking yourself: when to buy? So applying this to true investors. A true investor wants to see the price for his desired asset really drop, hit all-time lows. Sounds a bit like a sabotage, right? But it ain't. Now, imagine this. Let's say you were in the market, you wanted to buy a Tesla. So you look it up online and you see it's going for, say, 20 grand, which is a bit high because you've done your homework and compared the price range over a longer period of time. So you look a week later and the price is down to 15 grand due to smaller demand for that same Tesla. And as the weeks go by, you see it getting lower and lower, and the price of the car eventually hits 6 grand, and you're like, yes, I'm buying it. Because you know that it's, the average price is way higher. So you've made a deal. because you've calculated the average value of this asset. You know, someone newer to the business of buying Teslas might have panicked and bought one for 20 grand, thinking that the price would immediately continue getting higher. You know, I guess the analogy to Bitcoin and what happened in December 2017 is quite appropriate here. Now, another way you could have bought that Tesla as a patient investor is dollar cost averaging. So what dollar cost averaging is, it's an investment technique of buying a fixed dollar amount of a particular investment on a regular schedule, regardless of the price share. So the investor purchases more shares when prices are low and fewer shares when prices are high. So every month you're going to contribute the same amount towards that car. You know, if the price drops, you end up owning a bigger percentage of that Tesla until you've paid for all of it and you own it. An alternative method is to do a cost average of the asset. So you buy a bit of it depending on whether you have a statistical edge in your favor. So long-term investors want to see the price of that coin being discounted or dropping in the short term, because this lets them buy more of that asset. Simple as. If the price kept being high, then you're just not going to be able to buy anything because it's trading above its average cost. Most true crypto investors have ignored the fear, uncertainty, and doubt, so totally exaggerated by the media during the bear market of 2018, and have used it to their advantage by lowering their average cost per coin. You know, while everyone else is bailing out and quitting near the bottom just to save themselves from making a loss, these guys are buying more of the asset that they're interested in because it's at a lower cost. So start with making your decisions about what you will invest in, and then decide your best course of action for starting to own that asset at the lowest possible cost. If you're a true investor, that is. But what about if you don't want to wait a year or 10 years to average down and wait for your asset to hit all-time highs? What if you like the adrenaline of finding short-term edge, dynamic chart, and technical analysis? Well, in that case, you might as well adopt a trader mindset. A trader can hold positions anywhere from minutes to weeks, but rarely above that time frame. They see holding an asset for longer periods of times as a risk, and they prefer to be in cash or stable coins. They think that this attitude is way safer in the long run. Less wishful thinking, you know what I'm saying? So if that kind of describes you, then the question you need to be asking yourself is, what is your edge? Have you identified a pattern that allows you to accurately spot herd behavior so that you're able to quickly maximize profits and minimize risks? So it's all about, you know, are you able to see that pattern? Though, you know, it obviously isn't that easy, because if it was, everyone would be doing it. The usual chitter chatter. But price movement is a double-edged sword. Volatility, you know, is a bitch. It's really capricious. So paper profits are only paper profits until they're booked. The next question you need to ask yourself is exactly related to how much you can afford to lose, you know, the risk factor. So what are you risking on a given trade? Do you have clearly defined targets and exits? How will you know if you're wrong, and what will you do at that point to preserve your investment capital? Is it possible to define a trade structure that allows you to define risk ahead of time? So the biggest factor for the success of a trader is not always about how often they are right, because everyone likes to look at betting averages and win rates. Those are really immaterial. What really counts is how much they lose and how much they win. So this is where the concept of expectancy is really important. You need to figure out whether your net winnings are outpacing your net losses. So concluding, the answer to our main question, when do I buy, is really closely connected to your crypto investment method. Are you a patient long-term investor that sees the value in crypto hitting highs over the next few years, and you want to be there holding assets when it happens without having to hang over your computer for many hours a day? Then obviously your goal is to buy assets for your portfolio at the lowest possible cost, using the bear market to your advantage and not lamenting over it. But if you're more into algorithms, patterns, and you can see the psychology of the herd, you have the ability to spot the edge and herd sentiment, you can build your dynamic portfolio around short swings in price, technical analysis, and use short-term price targets. That's where it really starts. Though if you can't make up your mind and you see a bit of yourself here and a bit of yourself then it might really pay off for you to take a break, build a plan, or simply construct a more concrete strategy. There is really a lot of information on the internet that will help you decide on the best options for yourself. But remember to always read from a variety of sources so you make your own mind up about things. Good luck with answering these questions and building a really solid investment strategy that you're going to stick to no matter good times or bad times. Thanks a lot for listening. Subscribe if you haven't already, and I will see you in the next video.